And when you have the economy 70% consumption, you can't address those imbalances without a recession.
To see some sort of correction in the first quarter.
In our eyes, there's actually more fear right now.
Oh my God, the market's gonna crash. Hey everyone, Chris here, and welcome to the Business Report Show, where I give my insights on the world of business and investing. Few things before we begin. Make sure to hit the subscribe button, and if you do end up enjoying the video, hit the like button. Every little bit helps. Second, everything I discuss in this video are just my opinions. Success is never guaranteed. Always seek a professional before investing. Lastly, I've created the chapter timestamp links below in the description for those who want to skip through or to rewind back on the various concepts I'll be covering in this video. So you've probably seen an uptake in videos online from economists and other YouTubers talking about the market and how it's trending towards a catastrophic crash. You may have heard others say technical signs are showing the bears are in full swing. On the other hand, you've probably heard people say the stock market is so hot right now and up is the only way it can go. You know, after 20 years of investing, I've heard these same messages over and over again. After a long run of a bull market, the crystal balls come out and people start predicting the market crash. When you keep predicting the market crash, sooner or later, you'll be right. On the flip side, high growth bull markets make everyone look like superstars. All this said, I will admit prominent investors have been correct in their market crash predictions. One such individual is Peter Schiff, head of Euro Pacific Capital. Peter is a bit of a bear, but more so on the decoupling of the US dollar from the gold standard and the excessive printing of money by the Federal Reserve. Peter's best known for his prediction of the 2007-2008 financial crisis, where he clearly saw the over-levered housing market and impending disaster created by the mortgage bond market and credit default swaps. There's no shortage of video clips you can find on YouTube where analysts are laughing at Peter when he first made his predictions. It's actually quite entertaining to watch. I will say this, if you take a look at the chart of historical bull and bear markets, it seems like we are due for a bear market in the next 2 to 3 years. It makes sense that the market has continued its bull run. Really, the bull market is just continuing where it was originally headed prior to the pandemic, which is one way to look at it. Again, no one has a crystal ball because if they did, they would probably be quietly enjoying their immense wealth from seeing into the future. Now, there are many strategies to protect your financial assets. A few strategies I've learned over the years are best summed up in the book called The Little Book That Saves Your Assets: What the Rich Do to Stay Wealthy in Up and Down Markets, and this is by David M. Darst. I highly recommend his book, and I've included a link in the description below to it. For the purposes of this video, I've broken the discussion down into 4 concepts because I think each is foundational to building your protection strategy. Of course, it is always a good idea to seek a financial professional if you're unsure if these strategies are right for you. The first concept I will discuss is making sure you get your personal financial house in order. The second is understanding that our minds are both our best friend and worst enemy when it comes to investing. I talk about how we can better understand this and strengthen our investment behaviors. The third is having clarity and building a path. If you don't know where you're going with your financial goals, how can you properly plan for investing? And lastly, using proper asset allocation and diversification, not only to protect your money, but to also grow your money. All right, point number 1. Get your financial house in order. Before you begin investing, or even if you are in the midst of building your portfolio, having a solid financial base is vital to survive through times of economic difficulties. If you don't have a solid financial base, you may find yourself unnecessarily liquidating stocks at unfavorable prices, which is amplified especially when markets are dropping. Taking cash from your stocks in an emergency effectively kills your stock portfolio that you may have spent years building up. So my personal rule of thumb is to set aside enough cash to cover at least 3 months worth of expenses before I start diverting funds to investing activities. While I divert funds to investing activities, I do continually add cash to my emergency stash until I hit about 6 months of expense coverage. It is not until after this point that I begin to shift the majority of my funds to investments. The key here is not putting your emergency stash into the stock market or illiquid private investments. You want this cash to be highly liquid, as in an emergency, you need it right away. Ideally, you want this cash in a high interest savings account or in some type of money market fund so that it is earning at least some interest while it's sitting there as an emergency fund. I think this pandemic has shown us things can be down for an extended period of time, so the more you have in your emergency stash, the better. Number 2, you need to understand your psychological quirks and biases in order to train yourself to avoid poor investment decisions. Our brains are our best friend when we use it properly, but it can also be our worst enemy when it comes to irrational investing decisions. Our thoughts, feelings, likes, and dislikes influence our financial decisions as much as any other decision we make in life. Here are some general psychological quirks that humans have. Number 1, we are not predisposed to be patient. We like things instantly, which is why we love social media platforms where we get instant gratification. It also explains why some of us are so easily enticed by get-rich-quick schemes. Number 2, we have a biological mechanism that is more aroused when we anticipate profit than actually receiving that profit. This explains why some investors struggle to lock in profits and often hang on to investments longer than they should and end up losing their money. On the flip side, some investors don't hang on to stocks long enough and sell too early, chasing the next shiny object because the anticipated profit elsewhere is more appealing. Number 3, the concept of FOMO, or fear of missing out. We always want in on the next greatest thing and fear that it will never be available again. Investors often throw out logic and rational thinking just because of FOMO and end up chasing investments, which statistically leads to greater loss over a longer term. The reality is there will always be a next big stock, next greatest investment. When Bill Gates became a billionaire in the 90s, investment commentators would often say, if only you would have invested $10,000 at the beginning of Microsoft's IPO, you'd be a millionaire. People would lose sleep over having missed out on this once-in-a-lifetime opportunity that would supposedly never come again. Well, tell that to the people who have since invested in Apple, Amazon, Netflix, Tesla. List goes on. Every few years, a new crop of next greatest investments pop up. Okay, number 4, we look for mental shortcuts to avoid doing the work needed to succeed. This goes back to the get-rich-quick schemes that so many fall for because we want the quickest path to financial freedom and easily get distracted when we have to put effort behind our decision-making. So now that I've talked about 4 of the psychological quirks that humans have, what can we do? We need to build up a certain mindset when it comes to investing, and we have to consistently stick to this mindset. How do we do this? Number 1, learning that patience is the key even if you are planning to day trade or options trade. And what I mean by this is that patience in taking the time to learn the fundamentals and techniques in trading in those strategies first to save yourself a lot of grief. For investors wanting to build a retirement nest egg, there's a reason why Warren Buffett and Berkshire is one of the most successful investment firms in the world. Investing is about the long game, and don't let your biological mind mess with that. Number 2, have flexibility and willingness to learn different strategies that may go against your own ideas and thought. It took Warren Buffett a long time before he was willing to look at technology stocks, and some say he missed out on a lot of growth opportunities from companies that are now worth billions. Berkshire finally opened up their portfolio to some technology stocks, but even then they stuck to their tried and true model of investing. By learning about new strategies and opening your mind to different ideas, you may find yourself uncovering some great opportunities to really grow your money. Number 3, always review your losses and see what went wrong, and do this on an ongoing basis so you can adjust how you invest. When I first started reviewing the stocks I lost money on, I discovered that I chased to get in those stocks. I would set an order limit, and if it wouldn't fill immediately, I would adjust my order price to get in thinking I was going to lose that opportunity. In hindsight, I'm not sure why I even placed an order limit. I should have just placed a market order. Nonetheless, I don't chase stocks now. I put an order limit on a purchase, and if I don't get in on that day, I let it go. What I found was that I was able to purchase some of these stocks at a lower price at a later time because I could track its trading band and get in on the low, the buy low, sell high, right? Many of those stocks are ones I still hold long term and have given me the most gains over the last decade. Okay, step number 3. You need to know where you're going with your investment plan. Perhaps you're saving up for a new car or maybe a down payment for a home. Or perhaps you're looking to secure your retirement for the future. Whatever it is, you need to have this clarity and a plan that takes you to the finish line. It's like a business plan. Successful entrepreneurs have a clear direction on where they want to take their business, and they create a plan to take them there. They may adjust along the way, but they are hyper-focused and are able to stick to the overall plan. Understanding what your financial goals are will dictate what your plan is going to look like. For example, if you are saving up for a down payment for a house, your investment plan may be a little bit more conservative, as you would rather have the money available to purchase the house rather than risk it on investments. If you're in your 30s and settling down in your career, you may want to shift your focus more on growth investments, with a little bit of money allocated at higher risk investments that may bring greater returns. Your timeline gives you a bit more leeway to take a little bit more risks, and you may want to participate in some of those speculative opportunities that we keep hearing about. Having this clarity and creating a plan that you can stick to will allow you to make less knee-jerk reactions when investing. Okay, lastly, step number 4. In order to protect your investment portfolio, you need to have profit asset allocation and diversification. Right now, especially when the market is at its highs, there's no better time to work on asset allocation and diversification. The concept is to minimize the correlation between any negative fluctuations that may occur in any one of your investments. So for example, you may think that investing all your money into US stocks, but choosing different companies in different industries is a good diversification strategy. Unfortunately, history has shown that this isn't always the case. Take the recent global pandemic as an example. The majority of stocks all took a tumble in March, and it didn't matter what industry those stocks were in. Similarly, in the 07-08 financial crisis, most stocks moved in the same direction lower. So true diversification is actually driven by proper asset allocation. This means finding investments that have weak correlations to each other. Let's take an example of how this can provide you with a good defensive strategy. So suppose you split your portfolio into 4 asset classes, 25% in stocks, 25% in US Treasury bonds, 25% in physical real estate, and another 25% in cash and a high interest savings account. If the stock market was to take a turn for the worse, in this example, only 25% of your portfolio would technically be in jeopardy. Your physical real estate may maintain or gain asset value, but because you're not selling it, you're not losing a lot of money. US Treasuries would always continue paying its coupon rate, and holding it on to maturity would return your principal. Your high interest bank account would still have your principal cash, and interest payments would continue. So from a defensive strategy standpoint, only 25% of your entire portfolio would have exposure to a dropping market. The example did provide the 4 pillars that I like to focus on when it comes to asset allocation. So this is equity, talk about growth stocks, value stocks, small cap stocks, options, mutual funds, ETFs. You have fixed incomes such as corporate bonds or municipal bonds or federal government bonds. You have alternative investments such as real estate, commodities like oil and gas, you have gold, cryptocurrency, hedge funds, even art collectibles or vehicle collectibles. And a lot of people don't realize that this part of your portfolio could even be investing in a business or a side hustle. And then finally, the 4th pillar is your cash and cash equivalents, such as putting your cash in high interest savings account, GICs, or the money market fund. A strong portfolio would also have good diversification strategy within each one of these pillars. I will devote more time in separate videos to talk about how to invest in each of those asset classes, as there's just way too many strategies to cover in this video. What I will quickly mention is that depending on what your financial goal and planning is, how much you allocate to each asset class will also vary. A young investor with not a lot of debt or assets like a house may have 60% in equities heavy on the growth stocks, 10% in fixed income, like corporate bonds, 20% in alternative investments like crypto or maybe even a side hustle business, and 10% in cash. An investor in their late 30s or early 40s may have 40% in equities with a mix of growth and value stocks and some ETFs, 20% fixed income like corporate bonds and government bonds, 25% alternative investments like physical real estate or some private investments, and about 15 to 20% in cash. One last thing on this point I will say about equities, and in terms of protecting your portfolio, is to always put trailing stop losses. So if the stock falls below a certain percentage or percentage from the high, your trading platform will automatically trigger a sale and lock in the profits you have or minimize the losses you have. Statistics show that without automatic stop losses, people tend to hold on to stocks too long as they are falling, thinking they will climb back up in a short period. Many of the large cap technology stocks took over 15 years before hitting their 52-week highs from prior to the dot-com bubble. It would be nice to take profit near the highs and have the cash available to purchase some of these stocks when they dip to the bottom. As I said, more videos to come with details within each of these asset classes and some strategies behind trading. So to summarize, 1. Make sure your personal financial well-being is taken care of first before you begin investing. If you've already started investing, then take a pause and assess if your personal finances are ready to support you in case of economic difficulties. As a rule of thumb, have enough cash set aside to cover 3 months of expenses, ideally 6 months. Number 2, you need to build a solid investor mindset. Understanding technicals is fine and important, but markets are traded mostly by humans, so understanding human psychology, especially your own, will help minimize investing mistakes in the long term. Take the time to revisit investments you lost money on and build a game plan to avoid making those same mistakes. Number 3, once you've taken care of your personal finances and understand the psychological weaknesses you have to investing, then put a plan together for your investment strategy. Make sure you know what you want out of your investments, whether it's saving for a house, a car, or for retirement, but have a plan in place and stick to it. Number 4, ultimately protecting your portfolio once you start investing is about proper asset allocation and diversification within these various asset classes. And don't forget to place trailing stop losses on stocks within your portfolio. That's it for this video. I hope there were some takeaways for you in this video and that you can use it to help protect your portfolio from an impending market crash. Remember, history shows that bull markets always eventually fall, but reality is no one really knows when that's going to happen. So by taking some of these steps, you won't need to worry about when that will actually happen. You will be in a great position to pick up some great investments at discounted prices. Thanks for taking the time to watch this video. Remember, everything mentioned here is just for educational purposes. Make sure to consult a financial advisor before investing, as everyone's situation's a little bit different. Remember, always be learning, always be investing. I'll catch you in the next video.